Well, good morning, everyone, and thank you very much for joining us again for a sort of Landbay sort of economics webinar. I'm delighted to be joined again as sort of quite a regular with Simon French. Simon, for those who've been on before, he's chief economist and head of research from Panmure Gordon. He's also a regular columnist for the Times. And he's also, I noticed, won or was awarded by Institutional Investor, I think, top economist and top UK economist and strategist in the Institutional Investor Awards, which is fair to say it's the sort of Oscars of the city. Is that fair to say, Simon? And that was in the last couple of weeks. So,
thank you very much.
So again, the format is as normal. Simon's going to sort of run through for sort of 30-35 minutes or so, and then obviously we'll have time for Q&A at the end. We may do Q&A as we go along if there's something particularly relevant. So please do. You'll see we have some questions that people are sent in, but you can also enter the Q&A in the box on your screen, and we'll try and get through as many as possible. Obviously, a lot has happened this week. So our timing is extremely relevant, particularly with yesterday's decision, which no doubt we'll come on to. So with that, I'll pass over to you, Simon.
Well, thank you, John, and you're being very modest, actually, in terms of the timing is excellent. It's exactly a year on from the ill-fated mini-budget, hence the title of both the webinar and my slides that I'm going to present over the next half an hour, but also very, very timely given the interest rate decision yesterday, the market reaction that we've seen over the last couple of days towards UK interest rate expectations, inflation expectations. So that's going to be a lot of the content that I'll present in the next half an hour. But for those of you who joined this, I think this is the third time I've had the pleasure of doing this with Landbay, maybe even the fourth time, and it's quite a task-heavy presentation. But hopefully, if you like, a visual of some of the stuff that I will talk about in the next half an hour and giving you some of that data to play with. But the four themes I'm going to cover are actually the sort of what I've dubbed the 4 L's of the UK economy. And they're not all bad news. Indeed, while the first one is an acknowledgement that we've entered a low growth adjustment period, actually, low growth is considerably better, as I'll show in my first couple of slides, than was widely feared at the time of the mini-budget. There was expectations from the Bank of England downwards, really, that the UK economy would shrink in 2023. That has been reversed in its entirety. And actually, the level of scarring that was feared as a result of some of the impacts of the mini-budget and indeed some of the impacts of the pandemic have been recently revised away by the Office of National Statistics in what I thought was a fairly poorly timed data release, if I'm honest, on the last Friday of the summer holiday. Certainly kept me busy that day as it suddenly revised the entire UK economic narrative of the last 2 years. And I'll go through what that means. The second of my L's is lags. Lags in interest rate impact, lags in monetary policy. I know John's a very, very keen student of economic history and economic theory. I know that plenty of people are on the webinar, but it's the famed lag of monetary policy that is still to play out given the scale of monetary tightening that we've had. The third L is, if you like, the latent capacity still in the UK economy. We've got quite significant inactivity amongst the working age population that has built up since the pandemic. Whether that latent capacity can be put back to work is one of the big policy challenges and is key to whether the UK can start to return out of that low growth phase into a more sustainable 1.5–2% growth rate that we've become more familiar with. And then my fourth and final L, leverage. Now there is a lazy narrative actually about the UK economy that it's indebted up to its eyeballs, leverage really out of control. Actually, the data tells a pretty different picture, both benchmarked internationally and some of the deleveraging that's taken place since the pandemic. So I'll again cover that. But look, let's start with before we do any of this, address the title of the presentation head on. A year on from the mini budget, what scarring was there? What impact, what sustained impact was there? And the chart I've showed on your screen right now is the 10-year bond yield across all the G7 economies. And I think you can very clearly see in a year ago, September 2022, yields in UK sovereign debt gilt yield spiked much, much higher than the rest of the G7 at a time where there was real concern over the economic policies of Liz Truss, Kwasi Kwarteng. And then actually the repair job done by Rishi Sunak and Jeremy Hunt brought those back into line with their G7 contemporaries in relatively quick order, I have to say. It was something I dubbed in the newspapers the dullness dividend for UK policymakers, from being pretty dull and rather less exciting and erratic, if you might say, the Kwasi Kwarteng Liz Truss approach. But you'll also see later on in that chart, and more recently, actually that darkest blue line, the 10-year bond yield, has moved back up towards the top end of the D7 range, as concerns have risen about the fact that UK inflation had run rather hotter for rather longer than the rest of the world economy. And that, in my second chart on this section, will hopefully show you, there we go, the fact that there were fears, and I think, I wouldn't say well-founded fears, but there were certainly fears that were stalking capital markets during the first half of the year. The UK inflation, having in the last 25, 30 years pretty much man-marked the rest of the G20, the other major economies in the world, was starting to pick up back to the levels we saw in the 1970s, early 1980s, where the UK very much had an inflationary problem that looked out of kilter with the rest of the world. You can see that spike. But one of the reasons, if you're looking at current pricing of mortgage products, prices in corporate debt, sovereign debt markets in the UK, why they've moderated, because the inflation data has been materially better in the last 2 or 3 months. And that's going to be a big part of the next half an hour, is the fact that the UK let inflation rip, principally through the household energy route, gas prices, the energy price guarantee. But of course, as that goes into reverse, and it has, you get some pretty outsized moves to the downside, bringing the UK back into the pack. And if there's a big, upside at the moment of the UK macro, it's the fact that having been seen as a bit of an outlier, firstly because of the mini budget, and then secondly because of that sustained inflation at the start of the year, there's kind of a reassuring normality to some extent about UK macro at the moment, which is bringing inflation back into line. So section 1, the UK economy, my first L, it is in a low growth phase. But those who've listened to my webinars previously will know that the UK is sometimes presented always in a negative light, when actually the direction of travel from a conversation we could have had just 12 months ago is pretty constructive, pretty positive. The chart on the left-hand side, page 5, the light blue line, that's showing how consensus, not my estimates, consensus, this is pulled from 25, 30 economists across the city, was for a significant contraction, about 1% in the UK economy in 2023, based on what the economists thought the economy would evolve just 12 months ago. But notice that upgrade cycle. As we've gone through the back end of last year, and particularly this year, the estimates for the size of the UK economy is actually to grow by about 0.5% by the end of the year. And that is a good news story. I mean, unambiguously a good news story, because economists, very familiar with the scarring impact that a recession and a sustained recession can have on the economy. So the fact that that has been, at least for now, averted is good news. Now you'd ask, well, why is that? Well, there's a couple of reasons. Maybe I'd add 4, but there are 2 real workhorse reasons. Apologies for the police cars that keep coming, if you can hear them on the audio, keep going past. Must be some entertainment in the city this morning. But the point being that gas prices did a lot of the heavy lifting here, both in terms of suppressing expectations for growth, but as gas prices came down last winter through the spring and still pretty flat at about 130p a therm, as I'll show later, actually the growth outlook improved. So that just put spending power back into consumers' pockets. I got an email about half an hour ago from my energy provider telling me that my tariff's going down in October. That's just illustrative of the pass-through now from wholesale markets to consumer prices. Of course, the mini budget was reversed, and some of the fears over that was part of this growth upgrade, but also the economy has adjusted, not just to higher interest rates, but also adjusted to pandemic patterns, some of which have persisted and some of which have dissipated. And that adjustment factor just brightens the economic picture from what was feared a year ago. I want to take just a moment to talk about the upgrades that took place to the UK economy a couple of weeks ago. Why do I focus on it? Because we've been given a narrative that the UK economy was the slowest growing economy in the G7 since the pandemic. We were given a narrative that we haven't returned to pre-pandemic levels of economic activity. And then those fantastic statisticians down in South Wales, in Newport, at the Office of National Statistics, suddenly decided to find a spare £38 billion down the back of the sofa. And actually, the chart there now shows the UK economic output is pretty much middle of the pack in terms of the G7 and has returned to about 1.5% above its pre-pandemic level. Kind of changes that narrative. You may say, well, this is just a narrative. It's for guys like you, the economists, to go on TV shows and talk about or write columns about. And actually, it does impact international investors' perceptions of the investability of the UK, whether they want to own UK companies, UK assets, own sterling, own UK government debt. That has had a material impact, and I think it's important to get that narrative back out into the public domain. The low growth picture, though, is pretty entrenched. This is the monthly growth picture for the last 18 months, and good luck, candidly, picking a trend out of that. I mean, the only trend you could say is that it's dotting around zero, but we've had the Queen's funeral, the coronation, extra bank holidays, weather events, meaning that economic output has been very, very volatile. So, fade the headlines you get each month in terms of growth, contraction. The overall trend is just very close to zero in terms of the UK economy. As I said, compared to the fears, that's better, but it's still not perhaps the reason to hang out the bunting, and still why there's quite a lot of caution amongst consumer and businesses going into next year. I mentioned the gas price. It's really important to visually show what's happened to the gas price. A year ago, or just under a year ago, the forward gas price was 500p a therm in the UK. That would translate, unchecked, to household bills of £5,000, £6,000, £7,000 for a dual fuel bill for the average household. The fact that it's come down to about 130p a therm is now coming through in terms of the pricing being offered by utility companies. It's much more consistent, we think, with about steady state pricing of about £1,800 per year. So very considerably less than would otherwise have been the case if some of that dislocation in wholesale gas prices across Europe being allowed to crystallise and indeed being sustained. The other thing, of course, as we build up to talk about interest rates, is the inflationary picture. And I've helpfully, I know John loves his politics and the fact the government has set itself a target to halve UK inflation by the end of the year. Where are we on that journey? Well, 7 months in terms of, or 8 months in now in terms of the data, we're actually pretty much on track. I suspect the government will hit its target to halve inflation by the end of the year. It looked a bit touch and go, I have to say, by the time of the April and May print, where that red line was trending pretty close to the kind of levels we saw last year. But we have seen now pay awards start to soften, core inflation start to soften, and some of those feed-throughs from food prices and energy prices start to moderate the rate of price growth. So I think, if you're probably putting me on the spot, inflation will be probably in the 4.5% to 5% range by the end of the year. Still uncomfortably high, but less of the pressure on the Bank of England to keep hiking rates, as we saw yesterday in terms of their decision to pause. And one of the other reasons, and this is my second section, why pausing was my personal view, and we exchanged messages earlier in the week why I thought the pause was the right call, is that we still have, in my view, about 60% of the impulse of the interest rate hikes that have happened so far still to crystallise for households. That's the famous lag, the second L in monetary policy. And how do I display that? Well, first, let's get out of the way where markets now see interest rates. having had to upgrade where we see interest rates all the way through the last two years or so. Actually, the block line here, which is the market's expectation for peak interest rates, is pretty much, as I left my screen 10, 15 minutes ago, about where current bank rate is. It's telling you the market thinks that interest rates have now peaked, bank rate that is. But bank rate is not what, of course, households pay. They pay mortgage rates. They pay the offered rates from the retail sector. And here is where, if you like, and I'll spend a bit of time on this chart. On the grey bars, you've got the bank rate, how that's evolved. And look at the corporate loan book. This is company overdraft, company loans, the yellow line, the red line. Those have picked up almost in tandem with the base rate. Suggests that the path through to the corporate sector was pretty instantaneous. A lot of corporate debt is linked to SONIA, the overnight interest rate that reacts almost instantaneously to bank rate. But look at the household sector, particularly the household mortgage sector. There we still have the loan book around 3%. Now, clearly, good luck getting, even with the excellent rates offered by Landbay, good luck getting 3%. The reality is our mortgage book is going to have to adjust as we go through the refi cycle. And you are probably looking at a multi-year headwind to disposable income as more disposable income is allocated to servicing that mortgage debt as the average interest rate on the mortgage book moves up. And our calculation was we're only about 40% of the way through that transmission. So if you're Andrew Bailey, if the Bank of England, the MPC, and we saw this in the comments yesterday, they want to see how that plays out, how the behaviour of consumers evolves, how the behaviour of households, how the reaction of house prices evolve before they make their next move. And therefore that underpinned why I thought it was the right call. And while it was a close vote, I thought it was the right vote. What has this done to house prices so far? Well, a year ago, we made the theory forecast at the time of the mini budget. The UK house prices would fall by an average of 14% in nominal terms, and about double that in real terms once you adjust for inflation. And the dots on the line here are showing how that real and nominal adjustments have taken place. Actually, and it might not feel like that for some, house prices have held up a little bit better than my central case, and partly because a lot of the banks have provided some forbearance, have been lent on by the Treasury to not tighten their underwriting standards as aggressively as they may otherwise have done. But actually also because the jobs market has evolved somewhat more favourably, with unemployment still at a pretty low point of 4.3%, meaning that distressed selling that really puts a strong downward move on house prices hasn't yet crystallised. But equally, I'm very, very mindful that the impulse is still to play out for a lot of households. And therefore, we're sticking with our view that adjustment is probably going to be on a par with adjustments we saw after the global financial crisis and after the 1990 events in the UK economy. And to calibrate to those 1990 events, I'm going to skip through this chart on quantitative easing in the interest of time and look at how much mortgage interest payments for the average household have gone up in the last 12 months and put those in their historical context, page 15. Household mortgage interest payments across the whole stock are up, we think, about 60%, 60, from 12 months ago. That gives you a sense of some of the rate of change, if you like, the shock factor to household incomes. The last time we had that was July 1989, and you don't need to be a hugely studied person on the UK housing market dynamics to know what happened in that period. So I think we do have to take that adjustment, perhaps not in absolute terms, but nothing like the interest rates that took place during that period, but the relative adjustments in the amount of mortgage interest payments that households have to find are in that kind of ballpark. And you get that from the RPI data that was released earlier on in the week. The other part, and John and I were talking about this before the webinar began, is what is starting to happen in rental markets. And when we're thinking of the political response from the Rishi Sunak government on net zero, particularly the reduction in the requirement to reach EPC-C rating by 2025 for rented properties, that's a very clear acknowledgement from number 10 that they're seeing real stresses and worrying about the political blowback of what's going on in rental markets where the inflation is at a level we haven't seen in about 25 years and going up pretty quickly. And so trying to reduce the stress in that sector, and John very kindly said I write a monthly column in the Times newspaper. This time last year, I wrote about the fact that nobody was talking about the rental market. The August Monetary Policy Report 2022 from the Bank of England did not mention the rental market once. It had 54 mentions of the mortgage market, not a single mention of the rental market. I don't think either for monetary policymakers or indeed for government that will be viable going forward. Renters, the rental market, will absolutely be front and centre of the political battle that we'll have going into the next general election because of the dynamics in that market. Another of the reasons why, encouragingly, interest rates, I think, now have plateaued is the data has supported that picture. Core inflation, which if you strip out the volatile food and energy components, had been really, really strong. This is the Manhattan chart, the blue Manhattan on the left-hand side of page 16. Picked up really strongly at the start of the year. One of the reasons why UK inflation decoupled from the rest of the world is the national living wage fueled something of a little mini wage spiral in the UK economy around April, May time. But notice the latest Manhattan, the latest blue bars. The last three inflation prints on core month-on-month inflation have come down quite considerably, actually. And if you were thinking about, what clinched it for the bank yesterday, in fact, they voted on Wednesday, but announced yesterday, it was probably this month-on-month core data that, having been running way out of control from a 2% inflation target standpoint, and now hitting the three successive months levels much more consistent with hitting 2% inflation. The other thing is on the wages side, we've seen two successive months of payroll reductions in terms of the average wage, having been very, very strong in Q1 and early Q2. So again, a data picture that was supportive for the Bank of England to go on a pause picture. And as I left my screen this morning, about a 75% likelihood they'll also keep interest rates unchanged for the November meeting, when they'll have a new set of economic forecasts to play with. And
Simon, can I just ask? And no doubt we'll come on to, falling rates at some point. But how, once the market accepts, and whether they accept it now or whether it's in November, that we're at peak interest rate and we don't know how long that peak's going to be, behavioural impact do you think that will have, not just on the housing market, but on equity markets, investors in the UK, general consumer confidence? Is there a sense that suddenly people think, oh, we're through the worst of it, we can now get on and make those decisions to either spend money, to invest, et cetera, et cetera?
Yeah, I think that's absolutely right, John. If you saw the big movers in terms of UK public equity markets in the last couple of days, it was the house builders. And the house builders haven't suddenly been able to update the market on more volume, an easier ride from Michael Gove. None of the fundamentals have changed, but there was a perception that investors were buying into, which was that this plateauing of interest rates was enough for the forward path of their pipeline through 2, 3, 4, 5 years to be more favourable. We're not, the market back in July, early July, saw peak interest rates of 6.5%. The fact that we're looking to peak around 5.25% is those parts of the market, house building, those associated with house building volumes, have told you in terms of their public equity market pricing that they're anticipating a more favourable backdrop. Now, I don't think the whole sector is out of the woods, but of course, investors are pretty forward-looking in terms of this, and therefore they're prepared to offer more favourable cost of equity terms for publicly listed companies exposed to that sector. So I think that's the right interpretation, even agnostic of any cut. And just to give an extra parallel, the US house building sector, last time I checked, was up 110% this year in terms of its equity market performance. From a Federal Reserve that keeps on talking about holding interest rates exactly where they are, not even any talk of cuts of interest rates. And the offered 30-year mortgage in the US is about 7.3%. So the market didn't need to see a talk of cuts or even some pricing of cuts. They just needed to see things not going up further for a big response in US and UK public equity pricing. And on that note, just sort of to finish off the interest rate picture and the inflation picture, there will be people on the webinar who go, oh, hang on, you're another economist who doesn't talk about money supply, and will really frustrate some people. I don't talk on money supply because, you know, money has a role in terms of driving long-term inflation path. And for the first time in my lifetime, broad and narrow money, M2 being narrow money, broad money being M4, being contracting in annual terms. So we had contractions in broad money after the global financial crisis. This is the first time that I can see that we've had contractions in both. Now, money supply has a pretty ropey record of predicting short-term inflation moves. But in terms of the long-term, if you like, another body of information why the Bank of England might say, hang on, we've probably done enough here. Those dynamics in monetary aggregates are an important thing. We'll skip over some of the stuff on food because I'm mindful of time and I want to keep moving with the third L, which is the latent potential that the UK economy still has, actually. And it comes out of what has been a difficult story to tell on working age inactivity. Here we've got the seven major economies to make up the G7. And the UK's inactivity rate, that's the number of people aged 16 to 64 who are not in work and not actively seeking work. The UK is an outlier, not a good outlier. It's seen inactivity pick up when all other than the US have seen declines actually in overall working age inactivity. Why is that? And what does that do to the economic potential? Well, mainly the long-term sick. It's those people who have declared themselves not ready for work, not available to employers. And that, having been steadily declining in the years up to the pandemic, has shot up from 2 million to 2.5 million. This is pre-existing health conditions whose treatment was disrupted during the pandemic, and mental health conditions, some of which were acquired during the pandemic, which mean there's now quite a considerable body, about 500,000 more people, who are just not work ready. It's why the government is focusing on interventions through universal credit, through work coaches, to trying to get the NHS waiting list down. Because if you're trying to get growth back into the economy, improve the economic picture, actually the easiest way is to find a group, and here it's 500,000, who were until quite recently attached to the labour market. They had work or they were seeking work and are now not. And if they've had a previous attachment, chance of being able to coax them back, get them work ready, make them available to employers is an important part of getting the growth story there. The other line on there is older workers, aged 50, 64, who have chosen for lifestyle reasons to not continue to work in greater numbers. Again, trying to get those individuals back into work, and some of it will out of necessity because of the fact the price index, inflation, is up a cumulative 20% in the last 2 years, does mean that those people who thought they could retire may actually have to reappraise how much they can afford to live off in retirement, how much more earned income they may need. But that's one of the, if you like, latent capacities, which if any government, either this government or any new government, wants to get growth back into the economy. I mean, we can debate about HS2 or new energy capacity, but the lead-in time to generate growth there is quite significant. This is by far, in my view, the easiest way to get back to growth if you can reverse some of those trends. The UK, though, has been underinvesting in terms of its capital stock, and there's a chart there about benchmarking our underinvestment in capital, and that's why still there's a real focus in trying to incentivize investment, why the changes the last budget, actually in terms of full expensing for companies, quite positive in terms of the investment backdrop. For all the gnashing of teeth about the corporation tax rate, actually full expensing was what UK businesses asked the Treasury in terms of encouraging business investment. The good news story for UK macro is the thing that no politician wants to talk about, which is net migration. Net migration was assumed to be running over a 3-year period of about 690, 700,000 cumulative back in February. And then gradually, this has been upgraded, or indeed quite rapidly upgraded to something like 1.2 million. Now, if we put aside the political tensions, the social tensions that generates, from a pure economic standpoint, actually that's quite supportive. You've got a domestic population who are reporting ill health, sickness, lack of propensity to work. Importing a labour supply, which has a pretty high propensity to work, is actually economically additive. And I'm making no value judgment on the politics or the desirability socially of that, just looking through an economic lens and what the UK economy can deliver in terms of growth. And then fourth and finally, before I open up to it, I think just looking at the chat and the Q&A, there are already questions there, so I want to give them good time. Let's talk about my fourth and final thing, which is leverage. And here I think there's a real misunderstanding of what has happened. So I'll take a bit of time talking about something I've talked about at previous Landbay webinars, which is the excess savings story. On the left-hand side here, you see there's a cash deposit in UK bank accounts. We know this story. I think most people know this story, that there was some unintended saving during the pandemic, quite a lot of it actually, about 300 billion in cash terms. That's the pickup in the green line on the left-hand side. And you know, that is still in cash terms largely there. It's leveled off. Households have not accrued much more in the last 6 months. But actually, when you take into account inflation, which erodes the value of a figure like 1.8 trillion pounds, which is the total amount in those cash accounts, it does look like the value is kind of back to where it began the pandemic. So it's harder to make the idea that there's now significant in real terms, inflation adjusted terms, savings flossing around waiting for households to put to work. They've used those to deal with the inflationary surge, but it's quite difficult if you assume that they have the kind of right amount of cash at the outset of the pandemic. Quite difficult to make the argument that they've got considerably more now. Inflation has eaten into that, and they've used those cash savings to keep consumer spending going through the winter and through the summer. What's a better picture, actually, in terms of the health of household balance sheets, is what's gone on in terms of total household debt, the other side of the coin, if you like. And here, inflation has, of course, eaten into the value of that debt, as well as some signs of the principal debt, the mortgage, the credit card balance, the loan balance, has been actively paid down. So in real terms, actually, we're about 200 billion, 250 billion lower in terms of the total amount of household debt that households had compared to the start of the pandemic, or indeed that they had ahead of the global financial crisis. There has been something of a deleveraging going on, which in sharp contrast to what's gone on in the US, where US households have really geared up in terms of their credit cards and loans. We haven't seen the same impact. So is that latent capacity for UK households to potentially spend more going forward? I think that's a plausible case. US consumers are getting stretched, and you can see that in terms of their savings rate. But I want to focus on the right-hand side on credit card balances, and what's happening with credit card balances in the UK. There's the red line. Credit card balances are down from their 2016 level by about 25% in real terms. There has been an active pay down. And one of the things that as an economist I found most fascinating is when you look at the behavioural reaction of households to a pandemic, to Brexit, to the economic picture. It does look like households have gone, well, look, my most expensive credit card debt, an average APR of 20, 21, 22%. They've paid those balances down quite considerably. And I think that's just a good behavioural reaction. It's one of the things that I revisit quite regularly in my Times column, the value of prices. Prices are a really important signal for changing behaviour. And I think UK households have taken the signal that the most geared part of their balance sheet, the most expensive part of their balance sheet, does need to be dealt with in what looks like a higher interest rate environment for a number of years to come. In terms of the corporate sector has done a similar thing, the right-hand chart here. Those big bounce-back loans, C-bills that were taken out by small and medium-sized companies during the pandemic, about half of those have been paid off. You can see the green line coming back down. And on the left-hand side, the Bank of England is reporting their expectations for default at kind of the lowest level we've seen since before the pandemic. So the corporate sector, although showing signs of insolvencies in some sectors, actually is, at least not based on the data, is showing rather less stress than we'd feared. If I'm worried about the, if you like, the impact of interest rates, I think the corporate sector has felt that pretty instantaneously. The SONIA-linked loans, instantaneous adjustment to interest rates. In contrast, the household sector, who I think there'll still be people in the household sector who are burying their head in the sand going, well, don't worry, there'll be a 3% mortgage rate along sometime soon, and I just hold this one out. I think that's where you have more concerns than necessarily in the corporate sector, where that adjustment has been pretty quick. And then my last couple of charts, before I open up to questions, some public sector debt, the government balance sheet. We're saying the UK's debt to GDP about 100%, is second only really behind Germany amongst the major economies. And actually we have a debt burden which on that measure is considerably better than other G7 economies. And also while debt interest has undoubtedly spiked because a lot of inflation-linked gilts, about £650 billion worth, have paid a big interest rate, RPI interest rate, which has been as high as 13% at the start of the year. That is starting to now come down. We're at 9% of RPI. I suspect we'll be at 7% of RPI by the year end. That debt also starting to come back into its range of allocating about 3% of GDP towards servicing the national debt. And the final chart is almost my favourite chart, because we always get a question about the politics of this. And going back to 1955, what's the growth rate in the UK economy under Labour governments and under Conservative governments? Well, basically the same. No politician will tell you, but from an aggregate level, from a GDP level, you can argue over taxation and more micro regulatory issues. But from a pure GDP growth perspective, very difficult with data behind you to say there's a particular difference between Conservative and Labour governments in terms of the type of growth or the quantum of growth they put into the economy. So, what are my messages? Key messages: low growth set to continue. There is, as a result of the interest rate increases being done, a lagged impact of policy. There is a third L, latent capacity is available, particularly in the labour market, and leverage has enabled UK households to get their finances, particularly their most stretched finances, on a more stable footing. The tagline I leave at the end is the question you always have: well, where do you see a recession? Will there be a recession at the end of the year, early next year? It's a question we always get as economists. The point I would make is that recession is always a bit touch and go if you're in that low growth dynamic. And that is the real challenge for whoever takes the economic reins of October next year for the general election. To try and move the UK away from that lower bound where a recession is always possible if a shock, an economic shock, a renewed shock in the energy sector, or a political shock comes along. And with that, I'll hand back over to John, I guess, to compare the Q&A. You're on mute, John.
Apologies. Thank you very much, Simon, both for pointing out I was on mute, but also for a fantastic presentation. We've got obviously lots of questions, and please do keep coming in. But obviously, as you can imagine, there's quite a lot around, I suppose, peak interest rate and when they therefore start falling. And on that, I mean, obviously, there's been lots of talk about, Table Mountain and higher for longer, but maybe not peaking as high as people thought. And so, let's assume we are at peak, and obviously there's the markets, there might be one more quarter at some point. But what does, because at the same time, you show the sort of that lag effects are quite material, which means that obviously just by sitting at 5.25, there's still a lot of effect to come through, which means that maybe the Bank of England has overdone it. And while they may want to, or they expect to keep at the current rate for quite a while, we may suddenly find that actually they've overdone it and they start cutting. And then linked to that, do you think there's a sort of level of inflation where they can't really start cutting till we get to, say, 3% or whatever it might be? Or will they be looking actually more around, are we heading into recession, et cetera? And what will maybe be the trigger for us to sort of actually start to see rates falling?
Yeah, I mean, great question. So on the first one, in terms of peak interest rate, the central banks around the world are a pain, as they were doing it at their jolly in Jackson Hole in Wyoming back in August. They've been a pain in their statements in recent days. Talk about this higher for longer environment, because what they don't want to happen is for the markets to, in effect, start doing the cutting job for them. And if you like, goading them in, pricing, interest rate products for a cut and loosening the financial conditions. When they do feel to squeeze out the last few percent of inflation requires financial conditions to remain pretty tight. And their thinking there is based on economic history, which is that when you have inflation of this magnitude, with the type of magnitude we've experienced in the last couple of years, very difficult to squeeze that quickly out of the economy. And try and make that a really practical example. Give you an example of how rail fares are set next January, or benefits and pensions are set next April. They take the inflation rates from July, September this year and apply it to the indexation next year. That has an echo effect that, if you like, embeds higher prices, albeit transfers or costs in terms of rail fares, student loans. And therefore, it's quite difficult to have those factors dissipate, because they have sustained echo effect by indexation, the basis for pay awards, the basis for negotiations, the basis for contracting. And I think central banks, knowing that, are worried that we're not going to go back to 2% very easily, and therefore feel they need to have that higher for longer narrative to squeeze out those second order effects. Now, then on to the second part of your question, well, is that credible? Is that credible if the economy weakens quite significantly from the hiking that has already taken place but hasn't yet crystallized? And certainly if you saw the Purchasing Managers' Indexes this morning, all sub 50 in the UK, suggesting a contractionary picture, how credible would it be the bank to hold 5.25% if the economy is in recession? And I think that's the real challenge for the bank, as one that, although its primary objective is to get inflation back to 2% and price stability, it does have a secondary objective in terms of supporting the growth agenda. And it'll be an intensely political period, won't it, next year, if an incumbent government is trying to go for re-election, and it is seen that the bank is being quite stubborn and quite dismissive of its second objective. The market, for what it's worth, prices the first interest rate cut in September of next year in the UK, a little bit sooner actually in the US, suggesting that it's just testing whether Andrew Bailey, Jerome Powell, Christine Lagarde are, up for the fight. My view is that while there may be some pullback of interest rates, I think the sense that and there was a big debate about 3-4 months ago, the IMF, the International Monetary Fund, talking about interest rates potentially going right back to their pre-pandemic levels. I simply do my reading of the sort of geopolitics, the investment backdrop, the amount of public sector debt that has now been accrued, particularly in the US economy. That's quite a difficult path for central banks to take from here. So some small cuts, the idea of big cuts back to pre-COVID levels, I think is not a credible set of expectations.
Yeah, and someone has asked what you think 2 or 3 years. I think that's probably too hard to get. But sort of slightly reinterpreting that question is, where do you think what can we think of as the new normal? Once we get through the cycle, is it 2%? Is it 2.5%? What's the rate that we're going to likely to live with for the next sort of 5 years or so?
No, I think it's. I mean, I won't dodge the question, although it's very kind of you to offer to give me a sort of free pass. I think 4% is about the bank rate that is consistent with the type of price dynamics we've got post-pandemic, some of the challenges of big capital investment on net zero, with obviously the changes this week notwithstanding. Why 4%? And you go, well, why have we gone past to come back? Well, that is the reality of printing a very, very high inflation rate. Is that often economists call it R and R star being the equilibrium interest rate, R being the current interest rate. you probably needed to go through what that equilibrium rate was in order to potentially come back as you see a print like the 3%, maybe high twos on the screen. There's a justification for just paring back interest rates, but more to that kind of range than back to the ranges we've been familiar with since the global financial crisis. And on that point in the US, which of course the US sets the precedent for all interest rates around the world, the Federal Reserve this week presented their latest economic projections, and they helpfully produced a publication of what they think the equilibrium interest rate is in the US economy. They think it's 2.5%. Is that credible? Well, they still think US interest rates will be 3.9% in 2026. So we have a bit of an internal contradiction in even what the world's biggest central bank and most powerful central bank are saying at the moment. I think that tells you how complicated that interest rate picture is if the smartest guys in the US room have got internal contradictions on where they think interest rates go over a three-year view and actually on a long-term view.
And then so on inflation, there's a question here about oil prices around, how concerned should we be about the sort of recent rise in oil prices? And obviously, as we are heading into sort of northern hemisphere winters, and obviously the war in Ukraine is obviously still sort of going on, and obviously you can see a scenario where those gas prices start to reverse up, as particularly if it's a cold winter, and then that feeds back through into, I guess, next year's numbers. Is that something that concerns economists, that we get a sort of another inflationary effect that may feed through in the beginning of 24?
Absolutely. So social media, which I'm pretty active on, challenges me on this point a lot because I've been calling for a pause for a while. I've been pretty sanguine about inflation coming down, and they're like, well, you're missing what's going on in the oil market and the food market. I'm not missing it, but you can only mark to market forward curve for oil, for gas, for food at the moment. And $100 a barrel sounds expensive, and it is expensive, but remember, $100 today was $80 2 years ago. That's what inflation is. And if you plug in $100 oil, it isn't consistent in my model with the US-UK inflation. It's not the type of thing that tips those economies into recession. The other thing I'd say is it's about twice as important, the gas price and the oil price in the UK, about twice the weight in consumer spending, given its relevance to both heating our homes for now and for the swing capacity for electricity generation. And that forward curve, now, notwithstanding events, Vladimir Putin may have different ideas, the Met Office might have different ideas, but the current trading position on UK gas is 130p pretty much across the board for the next 2 years, which is consistent with the considerably lower utility price than households had last winter. And I can only go on that forward curve. The Bank of England, when they model this on the first week in November, will only go on the forward curve, because it's a bit arrogant of me as an economist to say, well, that forward market is trading billions and billions of dollars of oil and gas contracts is not right, and I am. People on Twitter might think that they know exactly what's in the mind of Mohammed bin Salman or Vladimir Putin, and we should factor that into our forecast. But I wouldn't be a credible economist if I said, well, I'm going to assume $150 or I'm going to assume £2.50 on the gas price, when the forward curve isn't actually telling me that at the moment. It may go there, and that would be a big downside risk, and it would tip the UK economy pretty confident into a recession. But that's what the curve's telling me right now.
And then sort of one more on, and I'll come on to the election in a minute if we've got time, but one more on sort of house prices, because I think you mentioned in your presentation that obviously you're expecting some still further impact on house prices, something akin to maybe 2008, 2009. Is that's your outlook, that you still think there's still, because obviously there's been some sort of recent numbers that have come out in the last few weeks where house prices have started to soften off. So you still expect that to sort of continue for the next few months, do you?
Next few years, actually, John. Why? Because this is to be consistent with what I've presented, I try and, where I can, not have parts of my presentation contradict each other. And if you think about the delayed pass-through of interest rates, that mortgage loan book, which is currently 2.98%, I think, is going to go, I mean, we can debate whether it'll go to 5 or 6, or even 4. I don't think it'll go to 4, 5 or 6. But it's going to happen over the next 2 years as the refi cycle plays through. And those offered rates start to be the new, shape the new average interest rate. That's a multi-year event. And that's a multi-year change of affordability for households, but also takes out the disposable income that's available to service mortgages going forward. And that's one of the reasons why, and I take no pleasure in this, that forecast is, pretty cautious on the asset value for the next couple of years, because that has to play out. If that ratchets through or the loan book plays out, I think prices work in tandem with it. Now, you may counter, and it's entirely credible for you or any of the viewers of this to say, but hang on, people are forward looking. They may conclude that as that then plays out and we go out the other side, when we can justify that potential behaviour, the change in the interest rate curve, to justify allocating more of our spending to servicing my mortgage. That's possible, and that could put a floor into house prices. And similarly, might be that the government reaches for the sort of emergency ripcord going to the election and generates another version of Help to Buy. The Labour government come in with something very, very significant for first-time buyers or the broader market, which makes that assumption too pessimistic. But again, and maybe this is the flaw in economic modelling, which Ben Bernanke, of course, the former head of the US Federal Reserve, is coming in to do a review of the Bank of England's economic forecasting. We can only go on current policy, and at the moment they haven't got, son of Help to Buy or daughter of Help to Buy as policy. The Labour Party haven't really unveiled what they're going to do for the mortgage market. So I can only go on the policy backdrop and the known impulse from interest rates. I would change it very quickly if the policy environment changes. And Keynes said something about facts changing and his opinion changes, and he was a smarter guy than I am.
Yeah, thank you. And then, so one final one, we can squeeze one more in. Obviously, there is an election next year, both obviously, well, I suppose technically it could be January 2025, but we're going to be very much in an election campaign next year. It doesn't look like there's going to be any material wiggle room for tax cuts, et cetera, But obviously, this election, it looks now that from an economics perspective, there's not much between Labour and Conservative. What Rachel Reeves and Keir Starmer are offering seem to be, from purely economics and spending, just to match what Conservatives do. So is it significant from a UK economy perspective, the election, or not, do you think?
Not really. I mean, what would I say? So those of us with long enough memories for 97, the last time of the Labour to Conservative to Labour shift, remember the Ken Clarke economic plans, he was the Chancellor in 96-97, were inherited by Gordon Brown. And Gordon Brown made quite a big thing of holding the spending plans of the previous administration to minimise disruption. There was a lot of fear in Labour camps in 97 that the gilt market, sterling market, would just throw Labour governments out, a la Liz Truss quasi quato. That lesson of history, and history repeats itself quite regularly. And in terms of the advisors advising the Labour Party, they're the same people who were advising, largely the same people who were advising Gordon Brown, Tony Blair, 20, 25 years ago. That is a deliberate calculation. Now, just to illustrate that I'm not just it's exactly the same through the cycle, I think if you then, the gilt market doesn't fall out of bed, sterling doesn't fall out of bed, the economy doesn't collapse, you then start to see 18 months, 2 years in, as Gordon Brown did in terms of windfall taxes, changing the public spending profile from 99 onwards, I think you do start to see a deviation in policy. But I think for that first 18 months, 2 years, it's a very deliberate act, and one I think that is credible from Reeves and Starmer. They're trying to man-mark as much of current policy as they can.
Fantastic. Well, thank you very much for the hour you spent with us, Simon. Thank you everyone for dialing and listening in. It's fantastic to get your thoughts as always, Simon, and we're very grateful for the presentation that you gave us. Thank you.